In this video, I want to consider how to avoid investing in illiquid stocks. How to avoid investing in illiquid stocks. So in the course of this presentation, I want to consider a number of sub-headings here. And I'm starting with number one, Introduction to Illiquid Stocks. Introduction to illiquid stocks. Illiquid stocks are hard to sell, they are hard to buy without affecting the price significantly. So investing in these stocks can lead to a wider bid-ask spread, higher transaction cost, as also possess difficulty in exiting a position. You find it very difficult to very easily sell and exit your position. Number two, signs of illiquid stocks. Signs of illiquid stocks. There is low average daily volume. Low average daily volume. Stocks that are not traded frequently tends to be illiquid. The stocks are not traded frequently in the markets. They are considered illiquid. There's a wide bid-ask spread. There's a wide bid-ask spread. So a large difference between the bid, which is the buy, and the ask, which is the sell, which is the sell price. It's a sign. It's a sign that that particular stock is illiquid. It's a sign of illiquidity. It signals illiquidity. We also have small market capitalization. Small market capitalization. So smaller companies often possess fewer they often have fewer shares outstanding. So they have few buyers as well as sellers, leading to less liquidity. Then there is low institutional ownership. Low institutional ownership. So even institutions like large investment firms, mutual funds, hedge funds, the pension funds, if they're not really buying or selling these stocks, it might be harder for individual investors to trade it. So if it's difficult for these institutions to buy and sell, then it will equally be difficult for individual investors to trade these stocks. That's a typical, a sign of illiquidity. That's low institutional ownership. Number three is how to avoid illiquid stocks. How do you avoid illiquid stocks? So these are factors you need to consider. You check trading volume. Check trading volume. Look for stocks with consistent high trading volume. Been trading, consistently at with a very high, the relatively high volume. The next item is narrow bid-ask spread. It's a narrow bid-ask spread. So you consider stocks with smaller spreads. These are typically more liquid. In other words, you could find the bid, at let's say maybe $10, and then the ask maybe $10 $0.10. These are narrow spread, narrow bid-ask spread. The difference between the bid and the ask is not it's not large, it's not big, it's small. So invest in larger stocks. Invest in larger stocks. So in this case, we consider blue chip stocks as well as mid-cap stocks. These are usually, they possess better liquidity. They are considered, more liquid than other classes of stocks. And not only that, you also use liquidity metrics. you employ liquidity metrics. You have tools like daily average volumes and relative liquidity, can help assess how easy it is to trade a stocks. You consider average daily volume and relative liquidity. These tools will help you to be able to understand, how easy it is to trade a given stock. Please like this video and subscribe to this channel if you've not done that. Number 4 is strategies for managing illiquidity risk. What are the strategies you could adopt to help you manage illiquidity risk? It's a risk we cannot run away from, and we should find a way of managing it. So in this case, you diversify your portfolio. So you spread your investment across different sectors, across different industries, and also across different asset classes to avoid concentrating in illiquid stocks, to avoid kind of concentration on illiquid stocks. By the time you are fully diversified, so you stand a chance of avoiding stocks that could be considered illiquid. And you also set realistic entry and exit points. You set realistic entry and exit points. So avoid stocks with low liquidity when planning to make quick trades. You are a trader, you are a day trader, you want to quickly go in and come out of a stock, you must consider, the liquidity involved. You must set a realistic entry and exit points. The stock you want to quickly go into and come out of is the volume. Will the volume be able to, does it have enough volume to be able to cater for the moves you want to adopt, you want to execute? So set realistic, entry and exit points. Not only that, trade during market hours. You trade during market hours when the market is when there's a lot of activities going on in the markets. So avoid trading outside regular market hours as liquidity tends to drop, and illiquidity will increase in those odd hours outside the regular trading hours. So make sure that you execute your trades when there's much activity in the market, and that occurs during regular market hours. So in conclusion, avoid illiquidity or avoid illiquid stocks, by focusing on those with higher volume, narrower spread, and solid market presence. Popular stocks with narrow spread and higher volumes. You tend to have them in most mega cap stocks, large cap stocks. You can have these particular characteristics in them. So using liquidity indicators and investing in large, more actively traded stocks can help mitigate the risk of illiquidity. You consider the volume, consider stocks with large volumes that are actively traded. So by so doing, you can very easily avoid illiquidity, in the stock market.